This chapter 1 reviews general notions of interest rate risk in the banking book before describing the concept of repricing gaps and the use of a gap report to quantify and manage this risk via the so-called repricing model. The accrual or banking book of a financial institution consists mainly of interest rate sensitive assets and liabilities that affect the institution's net interest income, NII, but are not usually subject to fair value accounting, i.e., are not marked to market as rates move up and down. Throughout this module, we define net interest income as interest income minus interest expense. We will be presenting in this module two methods for measuring and monitoring the institution's interest rate risk for the banking book. The repricing model, also called the funding gap model, which analyzes the impact of interest rate movements on NII via the widely used technique known as gap analysis, and the duration model, also called the market or economic value-based maturity model, which analyzes the impact of interest rate movements on the market value of assets, liabilities, and off-balance sheet items to determine ultimately the sensitivity of the institution's net worth to those movements. This second approach offers a more comprehensive view than the repricing model of the aggregate impact of interest rate volatility on the institution's financial condition over the life of its existing assets and liabilities. We will explore each of these models, describing the steps they follow to measure interest rate risk, and compare the advantages and drawbacks of each. Due to the increased variety and complexity of banking products and the volatility of interest rates, the management of interest rate risk in the banking book has become increasingly challenging and a key preoccupation of bank regulators. So we will conclude this module by outlining the standardized model proposed by the Basel regulators for the management and supervision of this risk. The repricing model relies on so-called gap analysis to analyze the banking book's interest rate exposure. The model centers around the repricing dates of assets and liabilities and deems a maturity gap to exist when rate-sensitive assets and rate-sensitive liabilities have different repricing dates. Thus, a gap is rate-sensitive assets minus rate-sensitive liabilities. This gap is said to be positive when assets reprice earlier than liabilities, which occurs, for example, when short-term assets are funded with long-term liabilities. In such a situation, an increase in interest rates will have a favorable impact on net interest income, since funds received from maturing assets will be reinvested at a higher return. A balance sheet with a positive gap is alternatively described as asset sensitive. The gap is said to be negative, on the other hand, when liabilities reprice earlier than assets. This occurs, for example, when long-term assets are funded with short-term liabilities. In such a situation, an increase in interest rates will have an unfavorable impact on net interest income, since assets will need to be refunded at higher funding costs. A balance sheet with a negative gap is alternatively described as liability sensitive. Step 1 of the funding gap model requires the separation of balance sheet assets and liabilities into items that are sensitive to interest rates and those that are not. Each of the interest rate sensitive items is then slotted into time buckets, sometimes called time bands or maturity buckets, depending on when the repricing occurs, i.e. when the applicable interest rate is redetermined under the contractual terms of the instrument in question. Note importantly that for this purpose we ignore the instrument's maturity profile, which may be quite different. Thus, a 5-year floating rate loan indexed to 3-month LIBOR is slotted into the 3-month time bucket, its 5-year maturity being irrelevant for our present objective. The number of time buckets used under this approach depends on the specific business and product concentration of the institution and on the level of sophistication and liquidity of domestic interest rate markets. A typical bucket structure in the US often looks as follows: overnight, up to 1 week, 1 week to 1 month, 1 month to 3 months, 3 months to 6 months, 6 to 12 months, 1 year to 3 years, 3 to 5 years, 5 to 10 years, and finally everything else that's above 10 years. We will adopt a convention for the rest of this module to use the word from to mean from but not including, and to use the word to mean to and including. We will also use quite simply the letters D, W, M, and Y for day, week, month, and year. These two conventions together enable us to describe the time buckets in a very simple manner, e.g. the 3 months to 6 months bucket simply becomes the 3M to 6M bucket. We reach the fundamental rule for slotting items into their appropriate time buckets. Every asset, liability, and off-balance sheet item for which interest rates are risk factors that directly affect its value is slotted into the appropriate time bucket depending on its repricing tenor or remaining maturity, whichever is shorter. The gap for each bucket is next calculated as the difference between assets and liabilities in currency units. Cumulative gaps are also calculated for each bucket, being the sum of gaps up to the bucket in question, all of which we will illustrate shortly on a spreadsheet. Banks commonly control interest rate exposures by setting gap and cumulative gap limits. These limits may be defined in absolute currency units, e.g. negative 10 million limit for the up to 1 week bucket gap, or alternatively as a percentage of total assets or equity, e.g. cumulative gap limit for the 6-month to 12-month time bucket of negative 10% of total assets. We show here a typical gap report. A GAAP report is a snapshot of the institution's balance sheet as of a specific date. It is based on the book value of assets, liabilities, and off-balance sheet items as of that date. The GAAP report is often used by management to identify desirable modifications in the asset liability repricing profile and to express specific views on anticipated interest rate movements. Management can also use hypothetical GAAP reports to simulate the impact of strategic decisions, such as the launch of new products or the termination of others, on the institution's pro forma interest rate exposure. We now illustrate how various items are included in the GAAP report. Accrued and unpaid interest, itself a balance sheet item, is included in the GAAP report in the time bucket corresponding to its due date. The principal amount of the underlying loan or bond, however, is slotted in the manner mentioned previously, i.e. based on the shorter of its maturity or repricing tenor. In the case of zero coupon securities, the purchase price plus accrued interest, rather than the face value, slots into the appropriate bucket. Thus, a newly issued 5-year zero coupon bond with issue price of 8 million but face value of 10 million slots into the 1-year to 5-year bucket as an entry of $8 million. A fixed rate amortizing loan is slotted into successive buckets as per its amortization profile, while a floating rate loan that amortizes slots into a single bucket based on its repricing date. Take, for example, 2 customer loans, each with principal of $10 million, amortizing over 10 years in equal annual installments, one carrying a fixed interest rate, the second indexed to 6-month LIBOR. These are slotted into our previous GAAP report as follows. For the fixed rate loan, the first 1 million principal amortization slots into the 3-month to 1-year bucket. The next 4 million of principal amortizations slot into the bucket 1 year to 5 years, and the last 5 million of principal amortizations slot into the greater than 5-year bucket. For the floating rate loan, on the other hand, 100% of its principal amount slots into the 3-month to 1-year bucket, since 100% of this loan reprices in 6 months. Liabilities with contractual maturities are handled in a very similar manner. Their principal amount slots into the time bucket corresponding to the shorter of their maturity date or repricing tenor. Many liabilities, however, have a contractual maturity that does not truly reflect their anticipated maturity date, such as demand deposits, interest-free checking accounts, and savings accounts that pay a below-market interest rate and are often benchmarked to some regulated rate set by the central bank. These may be included in GAAP reports in a number of possible ways, 2 of which are summarized next. Method 1 is to use statistical and time series analysis to split the deposits into core and non-core portions. The core portion is deemed to remain stable over time and is thus allocated into some of the longer time buckets, while the non-core portion, viewed as more volatile and dependent on seasonal or cyclical effects, is slotted into some of the shorter buckets. Method 2 is to simply spread the aggregate amount of deposits over the successive time buckets on some kind of pro rata basis, or according to the best judgment and past experience of the institution. The importance of studying carefully the behavior of these types of deposits and then slotting them appropriately into the GAAP report is driven in large part by the fact that these liabilities represent a relatively cheap source of funds and yet may experience a significant runoff or withdrawal proportion in higher rate environments, when customers begin transferring their money into better yielding alternatives, forcing the institution to replace them with funding sources at market rates and adversely affecting net interest income. Some assets and liabilities may be prepaid at the option of the borrower, exposing the lender to the risk known as the prepayment risk of receiving the principal prior to the assumed maturity. For example, some customer loans, such as long-term mortgages in many countries, allow borrowers the right to prepay all or any portion of the loan at any time with little or no penalty. This exposes the lender to a compression in NII, especially when the loans pay a fixed interest rate and mortgage rates generally are declining, giving borrowers an incentive to refinance at a cheaper rate. In cases like these, assumptions regarding loan prepayment speeds become necessary, and cash flows of principal reflecting these prepayments are slotted into the GAAP report. Off-balance sheet items, such as swaps, futures, forward rate agreements, and interest rate options, are also sensitive to interest rate movements. We remind you first that we are dealing here with interest rate risk only in the banking book. Derivatives that fail to qualify for hedge accounting are usually classified in the trading book, for which VaR is used as the principal risk measure, as you probably know. For GAAP report purposes, derivatives in the banking book are first deconstructed into positions in the relevant underlying instruments and then slotted into the time bands accordingly. A pay-fixed position in a FRA is deconstructed into a combination of two positions, namely long, a bond with maturity falling on the contract's LIBOR reset date, and short, a bond maturing on the contract's settlement date, both with face value equal to the notional amount. For the FRA, the convention of the British Bankers Association, widely used in most markets, is to effect the actual settlement of the FRA as soon as the LIBOR fixing has occurred, i.e. at the beginning of the period, and to adjust for this early settlement by discounting the payment otherwise due at the end of that period at that same LIBOR fixing rate. We will ignore this convention in our discussion since it does not affect the interest rate sensitivity of the FRA, since early settlement has no impact on the cash flows sensitivity. Conversely, a receive fixed position in a FRA is deconstructed into a short bond position with maturity falling on the contract's LIBOR reset date and a long bond position maturing on the contract settlement date, both again having a face value equal to the FRA notional. Interest rate futures are handled in exactly the same manner. A pay-fixed interest rate swap is deconstructed into a long floating rate note and short fixed rate bond of maturities equal to the residual life of the swap, and both having a face value equal to the notional amount of the swap. A receive fixed interest rate swap is the opposite, i.e. short FRN and long fixed rate bond. Finally, options are converted, so to speak, into the delta equivalent amount of the notional underlying in a manner very similar to something we explain in our module on value at risk. We take a few examples and show how to slot them into our previous GAAP report. 10-year, $10 million interest rate swap, paying 5% fixed, receiving 6-month LIBOR. This IRS is deconstructed into two positions. Long, a 10-year, $10 million FRN, paying 6-month LIBOR, which is slotted as per its repricing tenor of 6 months. Short, a 10 million, 10-year, 5% bond, which is slotted as per its maturity of 10 years. $5 million, 6x18 FRA, receiving 4.5% and paying 12-month LIBOR. This FRA is also deconstructed into two positions. Long, a 5 million fixed rate bond maturing in 1.5 years. Short, a 5 million fixed rate bond maturing in 6 months. Third example, $10 million at the money 3x6 caplet on 3-month LIBOR struck at 4%. For this caplet, the fact that it is at the money means that its delta is approximately 50%. The underlying is a 3x6 LIBOR forward, i.e. one that fixes in 3 months, and therefore the position is equivalent to long a 5 million, i.e. 50% delta times 10 million notional fixed rate bond maturing in 3 months, and short a 5 million fixed rate bond maturing in 6 months. The final GAAP report looks as follows. Where positive numbers represent assets and negative ones represent liabilities. So far, our analysis has implicitly assumed that the institution is exposed only to interest rate risk in its local currency. However, many institutions are exposed to interest rate risk in foreign currencies as well. In such cases, GAAP reports and GAAP limits may be needed for each currency that accounts for more than a certain threshold, for example, 5% of total banking book assets. A consolidated GAAP report in which all assets and liabilities are converted into local currency is often used to aggregate the total interest rate risk. In such cases, limits are needed for open currency positions, or what are often called cross-currency funding limits. We next discuss how to use the gap report to measure the impact of interest rate risk on NII. Assume that the yield curve shifts upward by a parallel 100 basis points. We calculate the impact of this shift on the institution's expected NII over the next 12-month horizon using our previous gap report reproduced here for your convenience. We first make a few key assumptions. 1. The yield curve shift occurs instantaneously and rates remain at their new levels for the remainder of the measurement horizon. 2. Assets and liabilities maturing within the next 12 months will be replaced at the new interest rate levels. 3. Each gap amount is spread evenly across its time bucket, i.e. we assume a repricing date falling on the bucket's midpoint for the entire gap amount. The NII impact from assets and liabilities in a specific time bucket will be this amount here for assets and this amount here for liabilities. So, adding the two impacts and using the definition of gap as assets minus liabilities, we can more simply calculate the NII impact as this. And from this formula, we can summarize the impact on NII through this table here. For example, if the bank expects interest rates to increase, it would maintain a positive gap that will have a beneficial impact on NII. Conversely, to achieve a beneficial impact on NII, if the bank's view is that rates will decline, the bank would maintain a negative gap. We will discuss later the strategies the bank can follow to alter the sign of its gap. From assumption 3 above, we can calculate the NII impact for the 3-month to 1-year time bucket. The midpoint of the bucket occurs 7.5 months from today, so the remaining tenor of our measurement horizon is 4.5 months. Thus we have NII impact equal to 112,500. We now calculate the impact of the 100 basis point upward shift on expected NII over the 12-month measurement horizon, applying the actual 360 day count convention to be more realistic. The only affected buckets are those that end within the 12-month horizon. The following table summarizes the calculation. For example, for the time bucket 1 day to 1 week, turning red right now, the gap equals minus 10 million. The bucket midpoint is day 4, implying a remaining tenor of 361 days. The NII impact is simply the minus $10 million multiplied by 100 basis points and multiplied further by the remaining maturity using the actual 360 convention divided by 360. This leads in the bottom row to minus $100,278. We apply the same procedure to each of the other buckets. The next table calculates the impact of an opposite shift, i.e. negative 100 basis points, on expected NII, this time over the next 3-month measurement horizon, again using the actual 360-day count convention. It is clear that once we choose a particular rate shift, gaps lead us to the NII impact over any specified measurement horizon. Depending on the gap structure, the NII impact can be positive over one horizon but negative over another. In our example, the impact was positive over the 3-month horizon but negative over the 12-month horizon. Setting gap limits is also an effective tool for limiting the adverse impact on NII if we have a view on the worst-case rate movement. For example, if our assumed worst-case rate movement is a parallel upward shift of 200 basis points, the table below uses the gap report to derive a net interest income worst-case impact over a 12-month horizon. If the institution wishes to limit its adverse NII impact over the 12-month horizon to $1 million, for example, roughly half the total current NII in the table, it has an infinite number of gap limit combinations available to it. A simple solution would be to divide all limits by 2, but various business considerations are likely to favor one limit structure over others. As mentioned previously, gap limits can be set in absolute currency units, positive or negative, to limit the impact of yield curve shifts in either direction. An example appears in this table. Gap limits may also be set as percentages of total assets, total earning assets, or equity, as in this table. Finally, limits may also be set differently for positive and negative gaps, as here. We discuss next available remedies for an institution whose gaps do not comply with the limits set by management, as per the following table. There are 2 breaches of gap limits, one in the time bucket 1 week to 3 months, and the other in the time bucket 1 year to 5 years. To re-establish full compliance with its gap limits, the institution can use a number of different strategies, which we now illustrate in detail. The first strategy is to replace $12 million of long-term assets falling in the 1 year to 5 year bucket with 12 million of short-term assets falling in the 1 week to 3 months bucket. The gap report would now look as follows. This solution is attractive and quick to implement if the institution has liquid assets, such as long-term bonds, which can be sold and replaced easily with short-term bonds. Otherwise, its implementation may take too long. An alternative strategy may be to replace $12 million of short-term liabilities falling in the 1 week to 3 month bucket with an equal amount of long-term liabilities falling in the 1 year to 5 year bucket, as here. Again, this can be easily implemented if the institution is able to issue long-term debt or to convince its creditors to lengthen the maturity of their existing short-term debt, a task that may be difficult if the institution's credit is weak or if there is no long-term debt market for this currency, as with many emerging markets. Another solution would be to attract long-term deposits, which would require aggressive marketing and pricing strategies and probably significant time to implement. Other strategies involve both assets and liabilities simultaneously. Under one strategy, $12 million of short-term assets are added to the balance sheet and financed exclusively with $12 million of long-term liabilities. Under this strategy, total assets and liabilities grow from $300 million to $312 million. Under a second strategy, $12 million of long-term assets are liquidated, and their proceeds applied towards the reduction of $12 million of short-term liabilities. Here, total assets and liabilities would shrink from $300 million to $288 million, as you see here. One final strategy involves an off-balance sheet solution, namely interest rate derivatives. Remember that interest rate swaps, forwards, and futures are included in gap analysis as long-short combinations of fixed and floating rate bonds. An interest rate swap under which the institution pays fixed and receives 3-month LIBOR and having a tenor greater than 1 year and a notional amount of $12 million would achieve the desired objective. Derivatives are widely used in the management of interest rate risk. They are attractive because they facilitate the management of this risk without affecting the mix of assets and liabilities booked by the marketing and banking units of the institution. However, interest rate derivatives are illiquid and short-dated in many emerging markets. We conclude this discussion by listing the advantages and limitations of gap analysis. The principal advantage of gap analysis is that it is simple, intuitive, and easily accommodated by the institution's accounting systems, since it relies on book values. GAAP reports provide valuable insights on the institution's balance sheet structure, which is why many central banks and regulatory agencies require them. GAAP analysis suffers from various limitations, however. First, assets and liabilities may be priced off different yield curves, so liabilities may not offset easily against assets as assumed under GAAP analysis. Second, the impact of rate shifts on revenues from assets may differ from the impact on expenses under liabilities. Banks usually change the rates they charge on assets much faster than those they pay on liabilities. Third, the assumption that gaps are evenly distributed within each time bucket is not strictly correct. In extreme cases, in which assets reprice close to the beginning of the time buckets, while liabilities reprice close to their end, or vice versa, the actual NII impact will differ significantly from what we have described. Fourth, GAAP analysis depends heavily on the specific time bands chosen. Different time band choices may produce quite different risk sensitivities to curve shifts, especially if the amounts are not evenly distributed within the time bands. And fifth, GAAP methodology uses book values and ignores intermediate cash flows. So all bonds, for example, are treated in the same manner regardless of their coupon rate, a key variable from an economic perspective that GAAP analysis pretty much ignores completely. These various limitations have given rise to a second method for the estimation and management of interest rate risk in the banking portfolio, one that centers on the concept of duration. We present this method in the next chapter and highlight its differences from GAAP analysis. Chapter 1 finishes here.